Hello and welcome back to another edition of London Direct. I spoke to Akshay Kapoor last year and he had a pretty bearish outlook for the equity markets in 2013. He was also very critical of the special treatment that banks get. Well, I've been back to the offices of Gecko Global Markets to see if his views have softened. Well, we spoke last year and you were pretty gloomy about 2013 for the equity markets. At least you were predicting a big slump, I think 30 to 40% if my memory serves me correctly.
I think it was closer to 20 to 30 actually, but
okay.
I'm not hedging.
Okay, but given the start to the year that we've had so far, have you softened that stance?
Well, the first thing is it wasn't necessarily gloomy. That depends on whether you're long or short. So, no, you're right. There's been a sharp rally in the markets. I did say when we had spoken that there is a chance that the market might go higher before it goes lower, but a break of 1475 was not expected. So it's been a fairly sharp rally, and I think there is still a possibility of it going higher, albeit after a small correction in February. But I don't change my overall view for the year, where I think that a 20 to 25% correction is certainly needed. In fact, we'd probably be more now because it's from a higher level.
What do you think's been behind this boost in sentiment at the beginning of the year? Do you think it's the story in the US where we are, apart from the last GDP figures, starting to see some concerted growth? And are you convinced that growth is going to remain?
And that's a good question. Let's take growth in perspective. If you look at 2007, S&P EPS on an earnings basis, so what they call operating earnings, was somewhere around, I think, between $80 to $85. And when the financial crisis started in 2008 and 2009, that shrunk to, I think, about $45 or something of the sort. Now, that's recovered quite sharply. So in 2012, earnings were close to about 100, and projected earnings are 112 for 2013. Now, this is a number that I find pretty interesting, because if you look at this trend, there's already been a very sharp growth in EPS on the S&P. And in 2012, extraordinary items accounted for, I think, almost about $15 to the share as far as S&P is concerned. So I think a lot of these earnings are a little inflated. And I don't think the kind of growth that they're talking about, which is a 12% growth expected in 2013. So the current S&P is trading around 1,500. It's basically based off projected earnings of 112. Yeah, that's a 12% increase over what we saw in 2012. So I really don't think that can come. That's far too sharp.
The very fact that central banks have been so forthright with their actions went totally against your principles. But are we not seeing the payoff to those actions?
Sure, yeah. I mean, you can't bet against people like Bernanke or Mervyn King and company. But central banks have been extremely aggressive, and this is a manifestation of that. There's no doubt. But ultimately, the laws of economics must take hold.
But maybe there's an argument to say that this was a special occasion. They had to do something, and it's going to be okay, isn't it?
What's going to be okay?
But we're starting to see growth in the US. The growth in China remains firm, and there are indications that the situation in the Eurozone is sorting itself out. We've seen the Spanish PMI, for example, coming good again. And so it seems like the situation in Eurozone.
Yeah, but you've also seen Spanish bond yields rising again, right? You've not seen a significant reduction in bad loans as far as the Spanish CAJA are concerned. So what you've seen is a lack of news about disaster. You've seen nothing about fundamental change in the situation, which is basically over leverage, bad assets, lots of loans that need to be sorted out. Greece is still, though you're not hearing much about Greece, and the Greek stock market has doubled since its lows, the problems still remain. So the problems have not gone away.
Isn't the whole point with Draghi, for example, is that he's just bought the Eurozone time? And it might take countries like Spain a long time to sort out their problems, but the core of the Eurozone remains strong.
But the core, do you mean France?
Well, France is another story.
So it's only Germany, right? It's only Germany. Mm-hmm. It's only Germany.
Yeah.
So Germany remains strong, and Germany probably will for a long time because they've got a pretty good economic system and a good work ethic. Sure. But let's start looking at France. Let's look at Italy. Let's look at other places.
Let's move on to the situation with the banks. The last time we spoke, you were also very critical of the special attention they were getting from the government, the special treatment. Over the last week or so, we've seen Chancellor of the Exchequer George Osborne saying he'll break up banks if they don't follow the regulations, that they need to ring-fence the retail section from the investment banking section. We've also seen big fines for RBS over the Libor scandal, and also the RBS's head of the investment bank has been forced to resign. Do you think that banks are being forced to get the house in order?
I think an attempt has been made to get the bank's house in order, but I think this is completely the wrong solution. I don't think ring fencing would help at all, because most of the problems that occurred in the retail banking parts of the banks, right? It was basically because there was a lot of money created by central banks, and that money found its way into mortgages, either at Northern Rock or Bradford Brinkley, HBOS, or indeed even Lehman Brothers. So in a lot of cases, it was actually the retail banking arm which actually brought the investment banking arm down. So I don't see how ring fencing will help at all.
Well, it's always interesting to hear from Akshay. I'll be back on Friday with more interviews, but for now, goodbye.